Thanks, Kevin. I see you actually allocated Peter's 10 minutes to yourself.
That's the way autocracy.
My boss does that. My boss does that as well. Thanks to ODI for inviting me to talk about a topic that's very close to my heart, which is the role of the private sector in development. Our CEO, Tidjane Thiam, my boss, took part in the discussion that David Cameron co-chaired on the SDGs at the World Economic Forum in January, and we continue to be very much a part of that debate, and that's why I'm very happy to be here today. As a long-term investor in emerging economies, Prudential has a vested interest in sustainable development. We don't make money, we can't make money by exploiting short-term fluctuations or trends. We're making a bet on a country's long-term future. And more importantly as well, as a business that sells its products, savings and protection products, to the mass emerging middle classes, we can only be successful if that growth is inclusive. The private sector has an increasingly important role to play in development. Private finance now is the biggest provider of international flows to developing countries. But we need to do more. According to the UN, the SDGs will require somewhere between $3 and $5 trillion of annual investment for things like infrastructure, health, education. And at the moment, there's a shortfall of at least half of that. And it's therefore vital that we harness the power of the private sector if we want to achieve these important goals. Companies have a moral obligation to support development in the countries in which they operate, and that applies here as much as anywhere else. And that's one of the reasons why we support charity projects in every market we're in. But I'm not here to talk about that. It's through our core business that we have the biggest impact, and that is what I'd like to say a little bit about now. Most importantly and most obviously, we're employers. Development's about giving people security, well-being, dignity. And we as a company firmly believe that the best way to do this for millions of people in developing countries is the creation of large numbers of sustainable private sector jobs. That's how lasting prosperity is built and shared by all of a country's citizens. And Britain already plays a major role in this. In the last 6 years, the UK has created more jobs in Africa than any other investor, something of which I think we can be very proud. For us at Prudential, hiring local people is critical in Africa and in Asia. Most of our sales are face-to-face. That means we create a lot of jobs, and we invest in training and developments for our people. You may be more familiar with us as the 165-year-old UK insurance company. But in Asia, over the last 20 years, we've built an agency force of over 450,000 people, with a market leader in most ASEAN countries. And now we're building on this experience in Africa, which is a bit of Prudential I'm responsible for and why I'm here. We acquired our first business in Africa just a year ago. What have we found? There's no shortage of talent and energy and entrepreneurial drive in Africa. But what people do need are opportunities to gain good professional experience. We are doing our best to create these opportunities through career development, international secondments for our staff, as well as training. In Ghana, we've created about 300 jobs this year alone. Our entire staff in Ghana is Ghanaian. We haven't applied for a single work permit there. In Kenya, where we launched, as Kevin said, a couple of months ago, we've pledged to create 4,000 high-quality jobs by 2020. As well as creating jobs, international private sector companies can improve business standards to the benefit of customers and employees. This is very important to us. The nature of our industry is that customers give us their money, and we look after it for 10 or 20 years, after which hopefully we give them back more than they gave us. And for that, trust in the industry is vital. In most emerging markets, awareness of life insurance is quite low. penetration in sub-Saharan Africa is at or less than 1%. In Ghana and in Kenya, the regulators have taken a lot of good measures to improve standards and to grow the market. We're doing as much as we can to help them, sharing our experience of growing life insurance businesses, particularly across Southeast Asia. I'm not, but we as a company are doing similar things right now in Myanmar and in Cambodia, working with regulators to help define the regulation that will grow the industry for the benefit of everybody. It's good for us because it improves the standing of the industry, and it's good for the countries because a strong growing life insurance industry can drive development in a number of ways. I don't want to get into a debate about this, but in our view, the most important drivers of development really are four things: security, health, education, and infrastructure. We can't do much about security, but insurance companies can do a lot in the other three areas. Take health and education. Governments in developing countries must and want to promote social welfare, but they can't afford British or heaven forbid, French-style welfare states. And the private sector needs to play a role. Emerging middle classes in most countries need and want to pay for better healthcare for themselves and their families. Insurance is by far the best way of doing that. By pooling risk up front, everybody has the peace of mind that the healthcare will be available and affordable when they need it. Similarly, our savings policies enable customers to provide for their children's education, helping the next generation to make the most of their talents and to contribute to the country's future. Just as education empowers individuals, infrastructure empowers economies. As we all know, poor infrastructure is a big barrier to economic growth in Africa. Currently, the African Development Bank thinks it's only spending, Africa as a whole, is only spending about half of what it needs to address the infrastructure problems. But we also know that when credit is tight in the developing world, or there are economic shocks in the developing world, liquidity to developing countries dries up quickly. Capital flows go the other way. For development to be sustainable, governments need to grow domestic sources of capital. And you won't be surprised that I'm saying this, that a thriving life insurance industry can be a vital source of the long-term domestic sticky capital. What we do as an industry, we basically mobilize the savings of local people and invest them in long-term local assets that match our long-term local liabilities, and infrastructure is a very good example of that. So the private sector, I think, can help development in some by creating jobs, driving up governance and business standards, and life insurance in particular can help meet health, education, infrastructure needs. What can we do to encourage companies to invest more in developing markets? Well, first, governments themselves can do a lot to encourage private sector growth. This includes investing in education, building capital markets, and implementing pro-growth and stable regulation, and increasing regional integration. When I spend a lot of time talking to governments in emerging markets, and I find they're very focused on all of these issues. One area where I think they could do more is on regional integration. Take East Africa. On their own, countries like Tanzania, Uganda, Rwanda are maybe too small to attract big foreign investors, but put them together and suddenly you have a far bigger and more attractive market. If individual countries can work together to lower internal barriers to trade the way that in some ways Europe has, they will attract much more investment. Secondly, developing countries must be included in global governance debates. We live in a globalized world. The old aid-based relationships with developing countries has changed. Western policymakers and companies must realize that trade with developing countries will be just as important to our future as it will be to theirs. At the moment, a lot of the global governance framework, as Kevin said, is set by developed countries. This is despite the fact that this legislation can constrain the ability of companies to invest and operate in developing markets. We need to watch out for these unintended consequences and always ask what will the impact of regulation be on the developing world. And in addition to that, we need to continually challenge ourselves to make sure our investment proposition to Africa is timely, relevant and competitive. We're not the only part of the world that seeks to invest in Africa, and we shouldn't think that our historic advantage will be sustainable if we don't keep our eye on the ball. So I think my 10 minutes are more than up, but to sum up, we think private sector can be an enormous driver of development. I was very pleased to hear Justine Greening stress this in the House of Commons last week. She said that it's vital that we help people and countries end aid dependency through jobs. The Millennium Development Goals have helped lift millions of people out of poverty. The Sustainable Development Goals are a great opportunity to improve the lives of many more people. But there isn't enough aid money in the world to achieve the SDGs. If we're going to get there, we need sustained, strong economic growth in emerging economies. And that means growing the private sector through domestic and foreign investment. So we must make sure that the private sector is properly involved in the debate, which is why I'm very happy to be here today.
Thank you. Thank you very much, Matt.